massive Fed rate cuts could be right around the corner. We're going to give you the latest on this data and why I'm saying this. As well as that, I'm going to talk about the impacts to the markets as well as certain stocks that we invest in, like Tesla, and how these rate cuts could affect them. The first thing I think we need to establish in this video is the timing of the market's current expected Fed rate cut. So we're not expecting a rate cut until May 1st of 2024. And you're expecting a 25 basis point rate cut. The probability is 40.3%. There is a 28.4% chance we get 2 rate cuts by May. And there is a 20.5% chance that the Fed's funds rate stays at the current level through May. So there's even a greater chance that we see 2 rate cuts by May rather than the Fed funds rate stay where it is today. This probability has been rising. That's because commentary we have heard from companies, especially your retailer companies, and some of the delinquency data, the inflation data that we have gotten, really supports the Fed needs to start cutting rates. The Fed funds rate today is way too high. I'm going to go ahead and go over the first bit of data that is by far the most important. This is kind of your home run, if you will, data that supports imminent Fed rate cuts, like as soon as possible. Because this data is really bad. Really, really bad. Despite what you'll see with the government reports, despite what you'll see from the stock market, this data is not good. Specifically, what I want to highlight is auto loans. So this is delinquencies by the type of debt from 2006 through 2023. This came out on August 30th. So it's 3 days old now. It's very current data, just so everyone knows. Specifically, why auto loans is a problem. Well, your auto loan delinquency rate is 3.6%. This is the highest since you have seen since the beginning of 2010. During the peak of the global financial crisis, you had an auto delinquency rate of 4.4%. When you were technically in a recession, in 07, December of 07, you had delinquency rates of 3.7%, around 3.5 to 3.7% in this range when the recession was first declared. So you are at the same level of auto delinquencies as you were during the start of the great financial crisis. And seemingly everything is fine out there. At least that's what a lot of the bulls will tell you. And I'm not a huge bear by any means, but the data is the data. And you really can't argue with that too much. Now, specifically, why is auto loans so worrisome? Well, take for an example credit cards. Credit card delinquencies are at 3.8%. During a high of the great financial crisis, this hit 3.1%. They give credit cards to anyone. Let's be honest. It's very easy to run up a crazy credit card bill and just to not make your payment. But your auto loan, what you use to take your kids to school every day, what you drive to your job with every single day, what you need to survive with is your auto loan. You can't function or operate without your car. In many cases, probably 95% of cases, you need your car, right? This is not something you let go into, repossession or get delinquent. It's just not. It's the same as your house. Your auto and your house is the last thing that you are going to let get repossessed or go into foreclosure. That's why this is such a problem. When you couple this data with the personal savings rate, I talked about this in the last video as well, and it's going to be a part of this video because I think it's important to kind of flow these data points together to come to an overall bigger picture on what's happening in the economy. Look at the personal savings rate. It's at 3.5%. Basically one of the lowest points you've been at in a very long time. You have to go back to 2005 to get a personal savings rate this low. Now, you got to think about this logically. What is the reason why people save money or don't save money? Well, there's really two reasons. Either the cost of living is so high that you cannot save money, or you save money or don't spend money because times are great and you don't need to save money. Usually during a recession, like almost every recession we have seen in history, to some degree or another, the personal savings rate does rise. That's because people were spending a lot of money before the recession. And then they all of a sudden get fearful because, hey, we're now in a recession. I should save some money, right? That seems pretty logical. But I don't think that people are not saving money today because they're not fearful. In other words, I think you can boil this down to people just don't have the money to save. When you look at the cost of food, the cost of gas, your insurance, your energy bills, they have all went up 20 to 40% within the last 2 years. You might make a couple more dollars an hour, but it's nowhere close to compensating for the price increases we have already seen. So the inflation has already happened. You have not seen, by and large, wages coming even close to matching the price of your bills today. So I think this is a big problem when you consider right now to other points of history. And this is not a great thing if you consider maybe we're about to see a recession and people just don't have money to save. Good news is prices usually come down during a recession. But this is not great. On Friday, we got the unemployment rate for the U.S. and you just hit a new high within the last year of 3.8%. As you can see, we have not been this high, minus these kind of gray lines right here, in between here and here, where the government basically incentivized people to stay home. You have not seen unemployment this high organically since the end of 2019, the last time the Fed started cutting rates. Yeah, take a look at this chart. The Fed started cutting rates in May of 2019. When the unemployment rate started to spike. As inflation, as you can see from this blue line, and I was covering that, well, the red, I should say, is the Fed funds rate. The Fed started cutting rates actually June of 2019. Inflation was still going up in this time, right? Inflation on a core basis was 2.56%. Inflation by the end of 2019 was 2.74%. But the Fed was still cutting rates. From June throughout the end of 2019, the Fed funds rates went from 2.4% down to 1.55% by December. What did the inflation rate do? Well, it went from, again, around 2.5% to 2.75% within that same time period. This was because the unemployment rate started to rise at this time. Now, you can also see it with this chart. This is the federal funds rate versus core inflation. And look at 2019 again. The red line was going down, the federal funds rate, and even core inflation was continuing to rise. Now, I want you to pay attention to the trend of this chart. Usually, the Fed needs to get the red line above the blue line to conquer inflation. In other words, the Fed needs to raise the federal funds rate higher than core inflation to get inflation to come down. But pay attention to right here before you go into an actual recession. What tends to happen is the Fed cuts rates as inflation is actually rising. Now, a lot of this can be attributed to base effects, right? When you look at year over year, if inflation is looking like it's rising right before recession, on your year over year base effects, that means that the prior year, inflation was probably a lot higher and started to come down. So you have to take that into consideration. But back here in the 90s, what happened? The Fed started cutting rates. Inflation actually rose from, what was this, 5% all the way to about 6% right before the recession. But yet the Fed cut rates from 9.8% down to 8% during this same time period, presumably when inflation was actually rising. Take a look back here in 2000. What'd the Fed do? Well, they raised rates a lot when inflation was going up. They started cutting rates in December from 6.5% down to 4%. At the same time as the Fed funds rate was 6.5%, inflation was down here at about 3%. The whole time during this recession in the 2000s, inflation was still 3.5%. And the Fed cut rates down to 1.75%. Again, in other words, the Fed started cutting rates at the same time inflation was actually rising. That was because you were going into a recession. What about back here during the Great Financial Crisis? Same thing. Inflation, and let's zoom this chart in a little bit more. Inflation was actually rising again heading into the recession. And what was the Fed doing? They cut rates from 5.25% down to about 4.25% once the recession actually started. And inflation rose from 2.5% to 2.7% during this same period as the Fed was cutting rates. And then inflation ultimately peaked in July of 2008 at 3%. And at that point, the Fed had cut rates down to 2%. And then obviously the recession took hold and inflation really started to fall and the federal funds rate was at 0. Well, look at now. This chart is delayed a little bit. So the last actual data that we got, zoom this in a little bit more, was for March. So it's a little bit delayed, or May actually. So it is quite delayed. But take a look at where CPI is right now. So CPI on a headline basis is 3.2%. The Fed's funds rate is 5.5%. You are way above, I mean way above, where we were or where inflation is at 5.33%. The Fed funds, the actual inflation rate on a headline basis is way down here where my cursor is. Way down here. Fed's funds rate way up here. Okay. Look at core inflation. The latest reading we got for the month of July, core inflation is at 4.7%. Again, look at this chart. That would be right about here, give or take. So the Fed's funds rate is still well above even core inflation. This at the same time your auto delinquency rates, credit card delinquencies, consumer loan delinquencies are all rising to some of the highest points we have seen in over 10 years. Look at credit cards. I mean, again, auto loans is important because you need your car. It's not something you just go delinquent on. And I think that's probably the biggest thing Wall Street is not seeing right now. It's just the psychological aspects of defaulting on your car. You just don't do that. Again, you have to take your kids to school. You have to take them to doctor's appointments. You have to, you need your car, in other words. So I think that's what is really important. But even when you look at credit cards Credit card delinquencies are at 3.8%. You have not been at 3.8% for credit card delinquency rates since 2011. That's not great also. But then when you start to think about the banking crisis that happened in the beginning of this year, you start to think about student loan repayments that start on October 1st. Obviously, there's ways to extend it to lower your payment, but still, it's going to be a drag on the economy. You look at even more recent developments, like the UAW strike that is presumably going to happen by September 14th. That's going to cost the economy about $5 billion a week from some estimates. And then you think about other things, such as commercial real estate is going to be in a huge problem in 2024. There's not a strong case to keep interest rates this high. Now, I'm not saying the Fed is going to cut them to zero. If they did, there's a huge problem that we just don't know about yet. But to keep rates at 5.5% at the same time we're seeing this kind of data just doesn't make sense. Now, on Tuesday, we had the JOLTS job openings. Now, this is important because the Fed wants to see job openings falling, and that's exactly what they're getting. The forecast was for 9.46 million job openings. We came in at 8.8 million job openings. You fell off of a cliff as far as job openings. This is a really good sign. The economy is slowing down big time. And this was data for July. Imagine the data for August. So if you're the Fed at this point, you need to be somewhat forward-looking. Because this is, again, data for July. So imagine where the data is for August. You're probably under 7 million job openings at this point. Or in the 7 million job opening range. There's a strong case to start cutting rates here, rather than talk about increasing rates. And let's be honest, Fed Jerome Powell does not want to go down as the Fed that was too late to start raising rates back in 2021, and then raised rates too much and caused a massive recession. No. The Fed knows they can raise rates again if they need to. But some of the data is starting to show, definitive proof, again, the auto loan delinquencies, that there's no way that we ultimately avoid a recession. This brings us to the next point of this video. What effect could the Fed cutting rates? As soon as the next meeting. Probably not the next meeting, though. I think they should cut rates at the next meeting personally in September 20th. But probably by November, I expect we'll get a rate cut. Now, the markets, they aren't expecting that at all. There is no chance of a rate cut by November. There is a 65% chance the Fed stays where they are. There's a 33.5% chance the Fed raises rates again. And there is a 1.9% chance the Fed raises rates in September and in November. That would be just a delusional Fed at that point, okay, given the data that we are seeing. So how do the markets usually react to rate cuts? It's interesting because on one hand, normally the markets do great when the Fed is raising rates, because if the Fed is raising rates and there's higher inflation than normal, well, usually the economy is doing very well. Okay, usually the economy does well when the Fed raises rates, and the markets do well when the Fed raises rates. You guys can see this every time the Fed has raised rates in history. The markets have done well, pretty much. Well, this time has been a lot different. So the markets fell as the Fed raised rates. Now, more recently, the markets have retraced back to kind of the higher end levels. So what we've seen recently, really in 2023 since May, has been normal, believe it or not, during times the Fed has been raising rates. It was very abnormal in 2022 that the markets sold off as aggressively as they did when the Fed raised rates. Very strange. Very, very strange. That's why the 60-40 portfolio last year did very bad. It shouldn't have happened, but it did. So Now, what happens when the Fed starts to actually cut rates? Well, the first rate cut isn't usually a huge deal, because if inflation was high, I mean, the first rate cut, usually that's kind of like, hey, the Fed raised rates enough. They're just cutting rates, getting back down to where they need to be. And the markets usually take that okay. It's when the bigger rate cuts start to actually come, right before a recession, that the markets really freak out. So first rate cut, not necessarily bullish, but not super bearish. The preceding rate cuts are very bearish. As you can see from here, look at even 2019. The Fed cut rates a little bit, and the markets really rallied towards the end of 2019 and into the beginning of 2020. As you can see, I think this is a great example right here. But when the Fed took rates from 1.5% to 0 during COVID, I mean, the markets crashed. Same story back here in 07. I mean, there was a little bit of instability during the first Fed rate cut, but the first Fed rate cut, I mean, the markets actually hit a new high. And then once the Fed cut rates to 2%, did the markets start to actually crash. So you got to look at history as somewhat of a gauge of what can happen in the future, but it's not a tell-all be-all. I personally think, given where the markets are right now, the first rate cut, if the Fed orchestrates it well, and they say, hey, we've done a lot to get inflation down. Headline inflation is now 3%. The federal funds rate is 5.5%. We can afford to bring the Fed funds rate down to 5.25%. I think the markets would probably like that. Now, if the Fed did a big rate cut, maybe a 0.5% rate cut, markets would not like that, because they would say, hey, why? Why are you cutting rates this aggressively? And then subsequently, the next Fed meetings after that would be very important. If the Fed continued to cut rates, or if they held them. Right now is a little bit different, because everyone is expecting higher for longer. That's the only thing you're hearing out there, is higher for longer. So I think in this market environment, if the Fed started cutting rates after everyone was expecting higher for longer, it's probably not going to be a bullish thing. Just my opinion. It's not going to be bullish, because markets' expectations are for rates to stay high through most of 2024. I just don't think the Fed can do that without causing a major recession in the economy. Now, to the point of certain stocks like Tesla, if the Fed cut rates, that would be good for getting more people into Teslas. Tesla would likely benefit from that. Investing in Tesla's business, like Tesla expanding most of their factories currently, building a new factory in Mexico, opening different showrooms elsewhere, well, the Fed cutting rates would make that expansion effort a little bit easier. The cost of capital would be a little bit cheaper, because bond yields would come down. And that's what money competes for, is essentially bond yields. If you can get a risk-free return of 5% on a 3-month treasury bill, well, you're not lending any money out to Tesla or giving Tesla a cheaper interest rate than that if they went to the bond market, right? So I think it would be really good for Tesla's demand, as long as the unemployment rate did not start to increase quite a bit. If the unemployment rate starts to get into the 4s, well, yeah, it's not going to be great. Even rate cuts from the Fed will not help Tesla. Ultimately, I'm in the camp of Tesla is going to do great regardless, even if we did see a moderate recession. The switch to EVs is here, and it's here to stay. There's tax credits and government incentives, state-level incentives, to incentivize you to buy a Tesla. Not only that, the Cybertruck launches in 2024. So Tesla will do great in 2024. Either way, in my opinion. I can't come to a strong bearish thesis on Tesla, or really a bearish thesis at all, unless the economy went into a huge recession. And I'm not forecasting that. I don't think this is the time the debt bubble burst. When the debt bubble does burst, probably 5 to 10 years from now, yeah, that's a problem. De-dollarization, that's a problem. But it's not now. So I think with Tesla, you're just fine. Sure, could the markets fall and could Tesla fall with the markets? Of course, you should expect that. But I think Tesla will do just fine in 2024 and likely do much better than the broader markets. That's kind of what I think, and I know I'm going out on a limb here because not a lot of people are going to agree with me. A lot of people are going to disagree. A lot of people are going to use the data to fit their own narrative. But let me just tell you right now, I'm not super bullish. I'm not super bearish either. I think the odds are tilted towards, the economy going into recession, things not being great. But I don't really care. It's not like I'm short. I have some hedges on my portfolio, but I'm 97% long. So I would actually make more money if I'm wrong here. But from the data I'm seeing, it looks like the Fed probably going to cut rates in November. I doubt they would in September, because that September meeting, in my opinion, is going to be more so conditioning the markets to maybe the Fed has done enough. That's what I expect. The Fed's going to say, we're starting to see job openings coming down. We're starting to see the labor market coming in balance. We are seeing applications for home loans at the lowest point that we have seen since 1995. Actually, Elon Musk commented on this and said, wow, because mortgage applications are down 30% year over year. And 2022 is still not a great year for mortgage applications. And you're down 30% from even last year. So I think September, again, is going to be the meeting where Fed Jerome Powell says maybe we don't need to be as high for as long. And we are going to get a summary of economic projections in September. So we're going to get a new Fed dot plot. I'm almost 100% sure. So that dot plot could show rate cuts coming a lot sooner than what the previous dot plot showed. But ultimately, I think your first rate cut likely comes in November. That's going to be 1 month after student loan repayments kick in on October 1st. And at that point, we're going to have some data, at least some preliminary data on consumer spending and how the economy is doing. I think another thing the Fed is looking at that I don't think the markets pay too much attention to is what retail earnings have been saying and what CEOs have been saying at some of your largest retail companies. A Dollar General. I mean, out of all retail companies, a Dollar General should be doing just fine. But what did Dollar General say? Well, the chief executive officer, Jeff Owens, said on the retailer's earnings call that its core consumers continue to say that they feel financially constrained and are focused on buying necessities. It says earlier this week, a report from benefits software developer Propel Inc. showed that an increasing share of low-income Americans are behind on rent and struggling to afford food. What did Walmart say? Well, Walmart cut its outlook as more shoppers limit spending to essentials. Quote, the increased levels of food and fuel inflation are affecting how consumers spend, said Walmart CEO Doug McMillon in a statement. This actually sent Walmart down 9%. And this was back in July 25th. So, I mean, there's not a big or strong case to be had that inflation is going to rise from here. Yeah, sure, it's going to take a while to fall, and once a recession does actually happen, that's where the vast majority of the drop in inflation tends to occur. But historically speaking, the Fed does not need to keep rates this high right before a recession. They usually start to cut before a recession. So again, November looks like it could be the first rate cut. Now, this is obviously just my opinion, so come to your own conclusions and your own opinions based on the data. I would very much encourage you guys not to take any bias in this. Because if you're massively short on the markets, then sure, you're going to look at data differently. If you're massively long in the markets, then you're going to look at the data differently. But when you look at this objectively, like I have done here in this video, you can't really point to anything good that's happening right now with the consumer and with the economy. Good thing is inflation has come down quite a bit. A lot, actually. And even when you look at where the Fed funds rate is right now, based and benchmarking that to headline inflation. Headline inflation is, call it 3%, a little bit above that, but around 3%. Fed funds rates, 5.5%. That means net, well, the Fed is net 2.5% of a drag on this economy. Meaning you're 2.5% higher than the neutral rate, in which that's the point where the Fed is not accommodating the economy and they're not putting drag on the economy. So they're putting a substantial amount of drag on the economy. Even if they cut rates 0.5%, they're still having a 2% drag on the economy. So I think that is another thing that just supports the Fed does not need to be this high for the federal funds rate, given where the rate of inflation is. So again, come to your own conclusions. Let me know what your conclusions are down below in the comment section. Hit the like button and subscribe to the channel if you are hearing my voice. My name is Michael Tyler. Most importantly, enjoy the rest of your day and your holiday weekend, and I will see you in the next one.